Hi guys, my name is Shirvan Taz, and in this video, we are going to discuss the next part of our chapter number 1 for the CMA series, that is external financial statements. Till now, we have discussed what is external financial statement, statement of income or statement of profit and loss, and balance sheet. Now, we are going to discuss the statement of changes in equity and equity transaction. So, the first question in our mind is, what is the equity? Equity or stakeholder equity or owner equity, all these are the same. So equity is a claim that shareholder of a company have on the asset once the liabilities has been satisfied. Equity is also known as shareholder equity or owner equity. It represents the residual value of assets of a company after all the liabilities have been settled. Essentially, it is the amount that would be returned to the shareholder if all the company assets are liquidated and all the debts are paid off. So, here is the breakdown of equity. We know the company has asset, the company has a liability. So, when we deduct all the liabilities from the total asset, then the amount we will get, that amount is called the equity. This is a very simple calculation of equity, but it is not that simple as well. There are a lot of things, a lot of factors that are making an equity. There are a lot of components that are making an equity, and this is something we are going to discuss in detail in our today's class. While discussing the equity, we should know there are a lot of components that are inculcated while making the equity or while calculating the equity. The first component of equity is the common stock. The common stock is the value that represents the ownership share held by the investor, or the value of common stock is based on the par value of the shares issued. Additional paid in capital. This is amount of money that the shareholder have invested in the company above the par value of share. The third thing is the retained earning. Retained earning are the cumulative profit that has a company retained and reinvested in the business rather than distributed as a dividend. Then the treasury stock. Treasury stock represents the share that company has repurchased from the shareholder. Treasury stock is deducted from the equity because it represents the reduction in the outstanding share. Now, what is the importance of equity? For equity, everyone has a different significance. Like, for example, if you are an investor, so equity represents the value of your ownership interest in the company. Equity will provide a measure of company net worth and the financial health. For the companies, equity is important. It is an important source of financing. Companies can raise capital by issuing share, which increase the equity. And also on the balance sheet. On the balance sheet, equity is reported as a shareholders' equity section alongside the liabilities and assets. So, in summary, equity is a fundamental concept in accounting and finance, representing the owner's claim asset after all the debts has been paid. It reflects the net worth of a company and a key indicator of financial stability and the performance of a company. The next thing is the statement of changes in equity. A statement of changes represent a reconciliation of accounting period of a beginning balance for each component of equity to be ending balance. What does that mean? The statement of changes in equity is also known as the statement of equity or statement of shareholders' equity. It is a financial statement that provides a detailed reconciliation of the opening and the closing balance of shareholder equity for a specific accounting period. It summarizes the transaction and events that have impacted the equity account, offering a comprehensive view of how equity has changed over the time. Here is a detailed explanation. Like the purpose, the primary purpose of a statement of changes in equity is to provide the stakeholder with detailed information on the movements in equity component during the accounting period, and it also helps investor, creditors, and other users of financial statement to understand the factor contributing to changes in equity and to excel the company's financial health and the performance. There are a lot of components that has involved in making the statement of changes in equity. These are typically the opening balance, the net income or loss of the current year, dividend that has been paid, issuance of share, repurchase of share, other comprehensive income, changes in accounting policies and the correction of error, and there are other changes as well. So these are the changes that we are going to discuss in detail in our today's class. So first of all, we have to understand that what is the structure of the statement of changes in the equity. Here is the structure of a statement of changes in equity. This structure show the opening balance of each equity component and the additions and the subtractions of the component and the closing balance at the end of the period. So see, in the equity component, we have written the opening balance, net income, dividend, issuance of share, repurchase of share, other comprehensive income, and the closing balance. Like what was the balance in the opening? That was, for example, for the common stock, we have $50,000. For additional paid-in capital, that is 100,000. The retained earning is 200,000, and treasury stock is the 100,000. Other than this, we also have the OCI of 5,000. Now see, when we have issue, there is the issue of $10,000, and then our closing balance is 50 plus 10,000 is the $60,000. The capital was 100,000, and we have issued 20,000 in the additional paid-in capital. So keep in mind the par value, the actual value of the stock we write in the common stock, and the value we are getting excess on our capital, that is the additional paid-in capital or the premium on the purchase of share, that we will write in the additional paid-in capital. So there it is 20,000. The its retained earning was 20,000. 30,000 is the net earning of our current year. 5,000 we have paid in the dividend and 225,000 for the year-end closing balance. Say for the treasury stock, 10,000 we have the old balance, 5,000 we have repurchased the share, and the net value is 15,000 negative in the treasury stock. And the last is the OCI, that is the other comprehensive income. We have already discussed in detail what are the other comprehensive income, and I will put the link of this video in the description of that video. Now, their total equity is, for the overall opening balance of the total equity was 345, and after adjusting 30,000, 5,000, 30,000, 5,000 and 2,000, the closing balance of equity is 397,000. That is how the statement of equity or the equity is calculated. The next thing in the statement of equity changes is the elements. Like what are the elements that we will consider while making the statement of changes in the equity? The first element is the opening balance. Second, total comprehensive income. Third, dividends. Fourth, share capital movement. Five, reserve. Six, retained earning. And the seven is other equity movement. So, first of all, the opening balance. Opening balance, this is referred to the equity balance at the beginning of the financial period as we discussed in the previous example, and it includes the total of share capital, retained earning, reserve, and any other equity changes or any other equity component from the previous period. The next thing is the total comprehensive income. This includes all changes in equity during the period, except those that are resulting from the investment by distributor to owner. It is comprised of net of income or net of loss and other comprehensive income, OCI. OCI includes items like unrealized gains or losses or certain investment or foreign currency translation adjustment and pension plan, and the other gains and losses that are not the part of our daily routine of the business. Dividends are payment that are made to the shareholder out of the company's profit, the reduced retained earning, and overall equity. Dividend can be in the form of cash and it can be in the form of the additional share as well. The fourth element of the statement of changes in the equity is the share capital movement. Now, share capital movement This refers to the changes in the equity due to issuing or repurchasing the share. Issuing share increase the share capital and equity, while repurchasing share decreases them. The fifth thing, the fifth element of our statement of changes in equity is the reserves. Reserves are the portions of equity that are set aside for a specific purpose. They can include reserve, revaluation reserve, and statutory reserve as well. They are created out of retained earning and the other surpluses. The sixth element of our statement is the retained earning. Retained earning, we all know, that are the earning of accumulated net profit or the net losses that a company has reinvested in the business rather than distributed as a shareholder, as dividend. They are major component of equity and they are used to finance the growth of and the operations. The seventh thing is the other equity movement. Now, what are the other equity movement? This encompasses the various other transactions and adjustments that affect equity but do not fall into the categories mentioned above. This can include like changes in accounting policies, correction of prior period error, and transactions with non-controlling interest. Each of these elements help us to explain how a company's equity changes over a period of time or over a period of a financial period, providing us insights into its financial health and the decision made by the management. A statement of return earning reconciles beginning and the ending balance of an account. This statement is reported as a separate part in the statement of changes in the equity column. The statement of return earning is a key financial document that shows how much a company has earned, accumulated, and kept in the company since inception. The numbers provide insight into a company's financial position and the owner's attitude toward reinvesting and the growing in business. The statement of retained earning is also important because it provides a detailed information of a company over a specific period of time. We know that retained earnings are the portion of net income that has been retained instead of divided as a dividend to our investors. So there are some components while making the statement of retained earning. The first component is the opening balance of the retained earning. This is the amount of return earning that in the beginning of accounting period it includes all the retained earning from the previous periods. Then we will add or subtract in case of loss. If we have earned a profit, we will add this income, or if we have a loss, we will adjust this loss. Net income is added or the opening balance of the retained earning, and the net income is a profit that a company makes. This income is after deducting all the expenses, taxes, and costs from the total revenue. If company incurs a net loss, this amount is subtracted from the opening balance of the retained earning. After adjusting the net income or the net loss in the retained earning, then we less the dividend that has been paid. Any dividend or distribution of earning to the shareholder when a company pays out dividend, it reduces the retained earning. This section shows the total dividend paid to the shareholder during the accounting period. After dividend paid, we will do the adjustment of error and changes in the accounting policy. Now, sometimes what happens, companies need to make adjustment in the errors in the previous period in accounting policy. For example, the earlier company was using IFRS and now the company is using a GAAP system. So the policies that have been changed should be adjusted in the retained earning. And these adjustment can either increase or decrease the retained earning. And in the last, we will get the ending balance of the retained earning. This is the final amount of retained earning at the end of accounting period. And we can say it can be calculated as the ending balance of a retained earning by opening balance of the for we can say that the ending balance of our current year is the opening balance for our next year. And the next year we will do again the same process
starting from the opening inventory and then adjusting the net income loss, dividend paid, and the adjustment. All these things we will do it repeated. And that is how the statement of retained earning is prepared.
What is the importance of making the retained earning? The first significant importance of the retained earning is it shows the financial health. The statement of retained earning helps the stakeholder to understand how much profit the company has retained and reinvested in the business. A growing balance indicates that the company is profitable and reinvesting earnings, which can be a positive signal for the financial health. The second benefit, the reinvestment is and growth. Retained earnings are often used for the reinvestment in the business. This can include funding for research and development, purchasing a new equipment, expanding the operations, or paying off debts, or capital expenditure that can lead down. The third benefit is the shareholder insight. This statement provides shareholder with information how company is utilizing its profit. It shows whether the company is paying out a significant portion of earning as dividend or retain the earnings for as a fuel for growth. Another benefit is the management attitude. The statement reflects management strategy and approach towards the growth and the distribution of profit. A higher retained earning balance may indicate a focus on reinvesting in a business, while significant dividend paid may suggest a focus on returning value of a shareholders. The statement of retained earning is crucial for providing a clear picture that how the retained earning has been utilized and how they have contributed to the company's financial stability and the growth.
While making the statement of changes in equity, we should keep in mind there are two main types of equity securities that company issue to raise capital. One is the preferred stock and the second are the common stock. Both represent ownership in a company, but they come with different rights, privileges, and characteristics. The common stock is also known as the ordinary share. It represents the equity ownership in a corporation. Common shareholders have voting right and can influence corporate policy and decision, such as electing the board of directors. Whereas preferred stock is a class of ownership in a corporation with a higher claim or asset and earning than their common stock. Preferred stakeholder or the shareholder generally do not have voting right, but have a fixed dividend that is paid before the dividend is paid to the common shareholders. So that is what we can say is a common difference between the preferred share and the common shareholders. Talking about the characteristics of common and a preferred shareholder, we can say the first is the voting right. Common shareholder typically have voting right and usually a one vote per share basis. This allows them to vote on a key corporate matter like merger, acquisition, election of board of director, and other major policies. While on the same side, the preferred stock typically do not have any voting rights. This means they do not participate in the election of board of director or voting in the major corporate policies. Second is the dividend. Dividend for common stock are not guaranteed and can vary based on the company's profitability. If a company decided to distribute dividend to common shareholder receive after the preferred shareholder, and while there's a preferred stakeholder received a fixed dividend which is paid out before any dividend given to the common shareholder. This dividend are typically sent at time of issuance and do not vary based on a very company performance. So, preferred stock shareholder will get dividend on a fixed price, whereas common shareholder can get more dividend as compared to the preferred stock, or they can get the less amount of the dividend as well. The third difference between the common stock and the preferred stock is the capital appreciation. Common shareholder benefit from capital appreciation. If the company stock pricing is increased, the value of their shares goes up. Whereas the preferred stock does not generally get a benefit from capital appreciation compared to the common stock. Its value is most influenced by the interest rate and the fixed dividend payments. Then the priority in the liquidation. In the event of liquidation, preferred stockholder have a higher claim on the company's asset than a common stakeholder. They are paid after debts but settle before the common shareholder receives anything. Then the residual claim. In the event of liquidation, common shareholder have a residual claim on a company's asset. They are paid after all the debts and obligations that has been paid, even after the preferred shareholder has been paid. So there is a chance that the common stockholder will get the more amount uh, as their residual value or in the event of liquidation. But for the preferred stockholder, they will only get the fixed amount that they have invested in the shape of shares in the company. Then the last thing is the risk factor. Common stockholder consider riskier than the preferred stock before because it is lower priority in the dividend payment and as well as the asset claim. And that is the reason there are very highly risk share in the companies. In summary of preferred stock and the common stock cater to different types of investor in which different risk tolerance and investment goals. Preferred stock is more suitable for the investor who are looking for a stable income with less risk, while common stock is favored by those who are seeking growth potential and voting rights. Equity issuance. Equity issuance is a critical process for the companies looking to raise capital by issuing new shares to the stock to investors. We already discussed there are two types of share that can be issued by the company: preferred share and the common share. This process can be undertaken for various strategic reasons. That can be including growth, that can be including fund, that can be reducing debt or financing new project. So this all can be the reason for issuing a new shares. First of all, what is equity issuance? We can say equity issuance refers to the process by which a company generates fund by selling new shares to stock to investor. This share can be used to the public through a public offering or they can be sold to private investor. There are two types of issuing the equity. The first one is the initial public offering, that is also known as the IPO. When a company offers its shares to the public for the first time, it is known as initial public offering or IPO. This is significant a milestone for a company, marking transactions from a private to a publicly traded entity. The second can be follow on public offering, that is also known as FPO, or we can also say a secondary offering. An FPO occurs when a company that is already publicly traded issues additional share for the public. This is often done due to raise more capital after initial IPO. The third type of issuing a equity is a private placement. In a private placement, company sells share directly to a selected group or a private investor, such as a institutional investor, private equity fund, or a accredited individual. This method is often faster and less regulated than a public offering. The fourth way is the right issue. A right issue offers existing shareholders the opportunity to buy additional shares at a discounted price before the company offers them to the public. This allows current shareholder to maintain their proportional ownership in a company. And the last way is the employee stock options and the plan. Company may issue shares to the employee as part of compensation package. This can include stock options, restricted stock units, or employee stock purchase plans, which can be align employees' interest with the shareholder. What is the process of equity issuance? The first is the CNN planning. The company Board of director and the management decide to issue new shares, considering the amount of capital needed, the timing, and the method of issuance. The second is the regulatory approval. The company must obtain approval from a relevant regulatory body such as the Security Exchange Commission of and any authority which involves filing necessary document like prospectus. Once you have taken the approval from the regulatory authorities, then you have to engagement with the underwriters. Investment banks and underwriters are often engaged to help with the issuance process. They assist in pricing the shares, marketing them to potential investor, and sometimes guaranteeing for the sale of a certain number of shares. Pricing after engagement of underwriter, you should go with the pricing and marketing. The price of the new share is determined based on the factors like company's financial health, market condition, and investor demand. The shares are then marked to the potential investor through roadshows and the other promotional activities. And the last thing, issuance and trading. Once the shares are issued, they are made available for the trading on stock of exchanges. They are ready for public offering. This means shares are listed on a recognized exchange where they can be bought by the investors and they can sold by the investor as well. There are some benefits of equity shares or benefits of equity issuance. The first benefit is the raising of capital. The primary benefit is raising funds without incurring debt. Company can be used these funds for various purposes such as expansion, research and development, paying off the existing debts, or improving the infrastructure. Also, it gives the strengthen on our balance sheet. By issuing equity, a company strengthens its balance sheet by increasing its equity base and reducing debt's equity ratio, making it financially healthier than more attractive to the investors. Another benefit than the strengthening of the balance sheet, it also increases the public profile. Going through an IPO, that is initial public offering, can significantly increase a company's visibility and credibility, and it can attract more customer and partners and talent as well. But there are also some risk and consideration as well. The risk or that can be dilution of ownership. Issuing new share dilutes the ownership percentage of the existing shareholder, which can be a concern if it leads to the loss control or reduced earning per share. Another thing is the market perception. The market perception of equity issuance can impact the company's stock price. If investors believe the issuance is a sign of financial distress, it could negatively affect the company's stock price. And other one is the regulatory and the compliance cost. Issuing share come up with a cost. The process of issuing equity, especially through an IPO, involve a significant regulatory scrutiny and the compliance cost, including ongoing disclosure and reporting requirement. For example, let's take an example of XYZ Corporation. XYZ Corporation decide to expand its operational and need like $100 million in capital. The board of directors approve an equity issuance. They engage in investment bank and underwrite the offering. After regulatory approval, XYZ Corporation issued 10 million new shares at the price of $10 each through an IPO. The company successfully raised the capital, which can be used for the expansion or the debt funds can be used as another operation plans. In summary, equity issuance is a vital mechanism for companies to raise the capital and support their growth and operational strategies. It offers a way to access significant funding without the burden of debt. Through it comes its own set of challenges and the implication for existing shareholders as well. The next thing in the equity transaction is the treasury stock. What is treasury stock? Treasury stock refers to the previously outstanding shares that a company has repurchased from the shareholders, leading to decrease in the total number of shares available in the open market. These repurchased shares are held in company's treasury and not counted in the calculations of dividend of or earning per share. nor they do carry voting rights. Companies engage in share buybacks for several strategic reasons. Firstly, by reducing the number of outstanding shares, they can increase the APS. And as earning per share is calculating by dividing the net income by the number of outstanding shares. As treasury, we have already repurchased, so these are not no more outstanding shares. Thereby making decision performance, uh, thereby making financial performance appear more robust. This action can also improve the return on equity (ROE), a measure of financial efficiency because it reduces the shareholders' equity while maintaining or increasing the net income. Secondly, company uses excess cash for buyback of the return value of the shareholder without committing the long-term dividend increase, offering a flexible way of managing surplus fund. Thirdly, buyback can signal the market that the company management believes its stocks is undervalued, potentially boosting investor confidence and increase the stock price. Additionally, reducing the number of available shares can that worst hostile takeover attempt by making it harder to acquire to a gain of controlling interest. Company also use treasury stock for employees stock-based compensation plans such as stock options or restricted stock units, avoiding further dilution that will occur if new share were issued. From an accounting perspective, the cost of repurchasing shares is recording as a treasury stock, a contra and equity account that reduce the shareholder equities on the balance sheet. For example, if a company repurchases 100,000 shares at a price of $20 per share, then it will be recorded as 2 million a treasury stock and the overall equity will be reduced. The treasury stock can be reissued in the future, which can provide a source of fund or stock for the compensation plan. Through its reissuance must be managed to avoid negative market perceptions, while stock buybacks can enhance the key financial metrics and investor sentiment also. They also reduce the company's cash reserve, which can impact financial flexibility and liquidity. Therefore, company must balance the benefit of buyback with the need of maintaining healthy cash flow and financial stability as well. After the equity transaction of treasury stock, the next is the equity transaction under the cash dividend. A cash dividend is a financial distribution that is made by the company to its shareholders. It representing a portion of profit and a free cash flow, unlike stock dividend, which involves the issuing additional shares. Cash dividend provides shareholder with immediate monetary benefits. This form of dividends reflects the company profitability and ability to generate cash. When a company earns a profit and accumulates its retained earnings, it has the option to distribute a portion of these earnings to the shareholder in the form of cash dividend or reinvest it. The decision is usually made by the company's board of directors. How the cash dividend is calculated? For example, imagine a company like ABC Corporation. It is a profitable company and decide to declare a cash dividend of $2 per share. If an investor owns 100 shares of a ABC Corporation, then he will receive $200 in the cash dividend. This distribution is typically drawn from the company retained earnings, which are accumulated profit and has not been reinvested in the business or distributed to the shareholder till now. The dividend is paid out on a specific date, known as the payment date, and the following declaration date and the record date, which determines the shareholder are eligible to get the dividend. Cash dividend can signal a company's financial health and stability, as they indicates that the company generates sufficient cash to award its shareholder without compromising the operation and the growth plans. Regular and consistent cash dividend can attract more income-seeking investors, potentially increasing the stock attractiveness and the market value as well. A property dividend in an equity transaction. A property dividend, also known as a dividend in a kind, is which a company distributes physical assets or shares of a subsidiary of its company instead of a cash or additional share of its own. This type of dividend allows company to transfer ownership of a certain asset directly to the shareholder, often providing them with unique investment opportunity. For example, suppose XYZ Corporation owns a subsidiary and subsidiary name is ABC Manufacturing. So instead of paying a traditional cash dividend, what XY2 Corporation do, it decides to distribute the share of ABC Manufacturing as a property dividend. If an investor owns 100 shares of XYZ Corporation, they might receive a proportional number of ABC Manufacturing shares based on the declared dividend ratio. Alternatively, the company might distribute physical assets such as real estate, equipment, or other tangible property that is no longer required for its operation. This approach can be advantageous for the company as it allows it to offload non-core or underperforming assets without its cash reserve. For shareholder property dividend can offer diversification and potential upside if the distribution of asset or subsidiary shares appreciate in value. However, valuing and managing asset can be more complex than handling cash dividend. It requires shareholder to access the market worth and the potential risk associated with the property they have received instead of a dividend. The next is the stock dividend. Equity transaction under the stock dividend. We can say stock dividends are the payments a company make from its overall profit to the shareholders as a reward for their investment. Unlike cash dividend, which provide immediate monetary benefit, a stock dividend involves issuing additional share to the shareholder, increasing their ownership stake in a company. This type of dividend allows companies to reward shareholders while preserving cash for the reinvestment or for the other operational needs. Now take an example. For example, consider ABC Corporation, which decide to issue a 10% of its stock dividend. If an investor owns 100 shares of ABC Corporation, they will receive the additional 10 shares, resulting in the total number of 110. So we can say the investor who has before 100 shares, after receiving the stock dividend of 10%, now he has 110 shares. While the total value of investor holding remains the same. Initially, since the market price of per share usually adjusts to reflect the increased the number of shares. Now the investor now owns more share, which could lead to greater long-term value to the company growth and the stock prices increase. Stock dividend can be particularly attractive for companies that are rapidly growing and prefer to reinvest their earnings rather than distribute it as a cash. They can also benefit shareholder by deferring taxes as a stock dividend are not typically not taxed until the shares are sold. So unlike cash dividend, they are taxed in the year when they are received. Now you know something? Cash dividends are like not preferred by the share because whenever they receive the cash dividend, they have to pay the tax on the same time. For example, a person receive a cash dividend on 2024, so he has to pay the tax in the year of 2024. But in the stock dividend, he can hold it. He can hold the tax until he sold the stock dividend. So this is another benefit that a shareholder can do with getting the stock dividend instead of cash dividend. However, stock dividend can also lead to dilution as the increase in the number of shares can reduce earning per share and potentially impact the stock market price. For shareholder, stock dividend can be a way to compound their investment without additional cash outlay, especially if the company continues to perform well and the stock price appreciates over the time. But it also has some depreciation. For example, when you have 100 shares, your earning per share will be like 110. But when you have 110 shares, then your earning per share will be also increased as the number of share has been increased. A forward stock split is a corporate action that decrease the share price and proportionally increase the number of shares outstanding. This maneuver is often employed to make shares more accessible to a broader range of investors by lowering the price per share. Forward splits usually occur in a specific ratio, such as 2 for 1, or 3 for 1, or 4 for 1, or which dictate how many shares of existing share will be converted into. Now, for example, a company X corporation with a current share price of $100 and 1 million shares are outstanding. Now, if X corporation announces 2 for 1 stock split, then each shareholder will receive an additional share for every share they currently own. Therefore, a shareholder with 100 shares before the split will know he will own 200 shares. Although the number of shares has been doubled, but the value of the investment remains same because the share price is now halved. In case share price will be adjusted to 50, like post split, and the total market value of the investment remains same, that is 100, that is 10,000 shares, and like 20 shares is now for the 50 share per price. Before it was 100 share per price. So this is what we call the forward stock split. There should be a question in your mind that why a company will do a stock split. So the primary purpose of the forward stock split is to enhance the liquidity by making share more affordable for the small investor. Lower priced share can attract a broader investor base, potentially increasing the demand and the trading gains. So, while it does not inherently change the company's market capitalization or the value of share of total holding, it can have a positive psychological effect on the market. Investor may precise the stock as more attainable and potentially more attractive sometimes. Sometimes, leading a positive impact on the stock price over a time as more investors to buy it. However, it's essential for shareholders to understand that the fundamental value of their investment does not change immediately due to the split. Only the number of share and the share price are adjusted proportionally. As we go along, we have to write some notes and disclosure after at the end of every financial statement. So the statement of changes in equity is a financial statement, also a financial statement, and the details in the movement of a company's equity over a specific period of time. This statement includes various components and disclosure of that provide a comprehensive view of changes and affecting the shareholder equity. The first note we will write is the component of equity. This section we will outline different elements that make up equity, such as common stock, preferred stock, additional parent capital, retained earning, accumulative, and the other comprehensive income, along with the treasury stock. Each component represents different source or use of equity fund. The second, we will write the accounting policy. This section describes the accounting principle and the methods used in a company to preparing its financial statement. It includes like policies related to the revenue recognition, inventory valuation, that is E4, FIFO, depreciation method is straight line forward, straight line method, or any like other methods, and how changes in accounting policies are handled. After this, we will write the changes in the share capital. This section provides a detail on any changes in the share capital during the reporting period. This could include the issuance of new share, buyback, conversion of debt to equity, or stock splits. Each transaction impacting the share capital is explained with the reason and effects on equity. Another notes that we will be reading in the disclosure or the in the statement of equity is the dividend. This section reports from dividend declared and paid during the period, including cash dividend, stock dividend, and property dividend. It deals the amount, dates of declaration and payment, and the effect on the retained earnings. After this, we will write on disclosure note or comprehensive income. This section presents all the changes in equity that are not a result of the transaction with owner, such as net income and the other comprehensive incomes, like unrealized gain or losses and available for sale security, foreign currency translation adjustment, and gains or losses on hedging instrument. Uh, then we will write the retained earning. This section shows uh, the changes in the retained earning over a period, including net income, dividend paid, prior period adjustment, and the transfer from the other equity account. It reflects the accumulative amount of net income that has been retained in the company rather than distributed to the shareholder. Then, non-controlling interest. This section details the equity interest in subsidiary, not an attribute to the parent company. It shows the changes in non-controlling interest during the period, such as a share issued or purchased from non-controlling shareholders, and the same share for the net income attributable to the share-based payment. This section discloses information about share-based compensation, such as stock option, restricted stock, and the employee stock purchase plan. It includes detail on fair value of share-based payment, guaranteed, exercised, forfeited, and their impact on the equity. Then, changes in the accounting policy. This section explains changes in accounting policy during the period, including nature and the reason of change, the method of applying the change, and the impact on the financial statements. It helps stakeholders to understand how changes affect the comparability of the financial information over a time. And the last point is the correction of error. This section describes any correction of material error from the prior period, including the nature of error, the impact of previously issued financial statement, and the adjustment made to correct the error. It ensures the transparency and the accuracy in the financial reporting. Now, each of the components and disclosures plays a critical role in providing complete and transparent picture of our changes in a company's equity, helping investor, analyst, and other stakeholders to make a more informed decisions. While taking information or taking decision with statement of equity changes, we should keep in mind there are some limitations on this. The first limitation is the lack of context. The statement of changes in equity may lack of context in terms of explaining reasons behind changes in equity components. For example, it shows increase or decrease in retained earnings or other equity accounts. It may not provide detailed explanation of underlying transaction or event that caused those changes. Contextual information could include business strategies, economic condition, significant impacts, and impacting equity. And then the second thing is the historical information. Statement of changes in equity typically focuses on the changes in equity during the current reporting period, may not be provide historical comparisons unless explicitly stated. Historical trends in equity changes can provide valuable insights into a company financial performance growth, trajectory, and shareholder returns over a time. And there is a complex and interoperability. The statement of equity changes can complex and challenging to interpret, especially for non-financial experts. It's often involve technical accounting terminologies and detailed calculation related to various equity components, which may require additional explanations or not for clarity. This complexity can hide stakeholder ability to accurate access. The true impact of equity changes of companies, financial health, and the share value. Comparability issue is another limitation while making the statement of changes in equity. Comparing statement of changes in equity across different companies or period can be challenging due to variation in accounting policies, the treatment of non-reoccurring items, or changes in the reporting standards. This lack of comparability can hide the stakeholder ability to make meaningful comparisons and assessments of equity performance and management policies across to the similar entities over a time. Another limitation is the omission of cash flow information. The statement of changes of equity does not provide the information on cash flows directly. It focuses solely on the changes of equity. Understanding the relationship between equity changes and cash flow requires the referring statement of cash flow, which outline cash inflows and outflows from your operating, investing, and financing activities. Without this information, stakeholder may not fully grasp how equity changes relate to the company overall liquidity and cash flow statement. Third, limited insight and operational performance. The statement of changes in equity primarily reflect changes in equity due to the transaction with the stakeholder or other entity holder. It does not directly provide the insight into operational performance, such as sales growth, cost efficiencies, or operational challenges. Stakeholder interested in operational insight typically rely on income statement and management commentary to understand how operational factors influence the equity, movements, and overall financial health. They cannot get from the statement of changes in equity. For this, they have to rely on management. So that's it for our today's class. Thank you for watching. And if you found this video helpful, don't forget to give it a thumbs up and share it with your friends. For more in-depth CMA course content and updates, make sure to hit the subscribe button and click the bell icon so you can never miss an upload. Do you have any questions or topics that you would like to cover? Leave a comment below and I will be sure to get back to you. Follow us on our social media channels for additional tips, resources, and community support. Thank you again for your support. Keep learning and see you in the next video. Thanks for the watching.